Keith Tier is the US managing partner of Accelerated Digital Ventures, and he puts out a weekly newsletter, Venture Trends, in which he puts his prescient finger on the future of the venture capital industry. This Now.tv show is going weekly, and we're going to talk to Keith on a Thursday about trends in the venture business. Keith, it's May 15th, 2020. I'm guessing that the pandemic is dominating the thinking of VCs all over the world.
Well, you know, there's nothing like a venture capitalist or reinventing the future based on what's happening in the present. The present doesn't stay the same for very long in Silicon Valley. So it isn't a surprise that this week in the newsletter, almost everything in the newsletter is asking questions about what will change, how permanent the changes will be, both for companies and for investors. You know, will work become distributed? Will San Francisco remain relevant if work becomes distributed, given how expensive it is? So there's a lot in the newsletter about that. There's also a lot about whether investing will continue to be face-to-face and largely done by, let's call it, you know, people who believe themselves to be experts at picking startups, or whether it will be more of a data-driven, more like Fintech process investing. So there's a lot in the newsletter this week, and everything is about how impermanent the past is and how different the future is going to be.
Yeah, and of course, the best venture capitalists are the ones who bet most intelligently on the future. I have to say, though, that this conversation about whether or not Silicon Valley is going to remain the center of the American tech industry is an endless discussion, extremely narcissistic. What's changed then during the pandemic? Why has the pandemic accelerated the importance, or perhaps the problems of San Francisco and venture and Silicon Valley in terms of venture capital?
Well, I think the first thing to say is it's not clear that that has happened, but it is clear that lots of people are writing about whether it's happened. And you know, I would say that in the newsletter, you've got Fred Wilson, for example, from Union Square Ventures, who is a wonderful thinker, who writes a piece called Location and Work, and talks about both San Francisco and New York being incredibly expensive. But up until now, it wasn't really possible to choose not to be there. And that what the panic around coronavirus has created through enforced remoteness is some practices that are sustainable and may even be better in some cases than going to an office. And he asked the question, if that's true, you know, will other cities start to see the rise of the entrepreneur working for companies in the Valley of New York, but not actually living there themselves?
So are venture capitalists now, during the pandemic, are they putting millions of dollars into companies without even meeting the startup entrepreneurs?
Yep, that's definitely happening. Sequoia Capital announced this week that it's made 10 investments without meeting the founders face-to-face. I suspect, knowing Sequoia's practices, that is somewhat true, but not 100% true, because they tend to make investments after having known startups for quite a period of time and validating that the team successfully does what they say they're going to do. But I do believe that the final stage was done without face-to-face meetings. So I think that is happening. And NFX, which is a newer fund run by a group of people, but including Pete Flint, who was the Trulia founder, and James Currier, has put a website up. If you go to thecompanybrief.com, where you can apply for funding between $1 million and $2 million. It's entirely a virtual process, and they have committed to make feedback within 3 days and a decision within 9 days, and plan on deploying $20 million through that process. So things like that are definitely happening.
I'm curious, are there some VCs who are skeptical of that? After all, my understanding, at least, of the essence of the venture capital industry is you're investing in people rather than ideas. Are venture capitalists comfortable investing in Zoom people or virtual people?
No, it's interesting. At my fund, ADV, we have spent the last 3 years taking the approach of building a software platform using signals, data signals, to partner with other funds and to invest in their companies based on agreements we put in place with those other funds, where we actually don't have the right to say no to an investment if the company meets our criteria. So we might actually never meet the company, and it's all based on relationships with their lead investor, who does have a track record and is a person or a group of people, and the progress of the company according to various criteria. That is very close to some of what NFX is doing. Josh Constine left TechCrunch last week to join SignalFire.
Yeah, I saw that.
It's doing something very similar, using data to drive decision making. So I do detect pre-coronavirus, there's already a significant trend towards, let's call it venture as a service, based on data and relationships.
Keith, Fred Wilson, of course, is based in New York with his Union Square Ventures. Is this another New York versus San Francisco argument about who's bigger, who's stronger, who's better? Or is the rest of the country involved too?
You know what, there's always that, but I actually think that's a positive thing. Saul Klein in London has done an amazing job over a decade or more promoting London as a place to invest, and has successfully pulled an ecosystem around himself that's now a very sophisticated ecosystem with all stages of investors. And I doubt it would have been as good as it is today had Saul not done that, and his dad as well, Robin. I think Fred in New York has done a very similar job. And you can't knock somebody for pointing out the merits of their city, the infrastructure that it brings together, the talent, the money, and so on. That said, and I'm probably biased, it's pretty hard to compete with Silicon Valley as an equal, because Silicon Valley just has such an integrated set of elements that make doing a startup and taking the risk you need to take easier than it is in many other places. And I doubt they're thinking, I don't think anyone thinks they're competing. They're just seeing the world flatten, become more global, and more places become viable places to successfully do startups.
Yeah, you are biased. I know you live right in the heart of Silicon Valley, in the heart of Palo Alto, which is, of course, in the heart of Silicon Valley. But your wife, Janae Tier, who lives with you, I think might be slightly less biased. She wrote something interesting this week about the rise of the rest, didn't she?
Yeah, she wrote a report for Crunchbase called America's Mighty Middle. She interviewed Steve Case earlier in the week, who of course has been pursuing investments in the middle of America for quite a long time now. And she pulled together all the stats that show there is indeed a rise of the middle. Texas actually surprisingly topping the list of states where there's been quite a growth of investment over the last several years. And with the new opportunity zones that came out of government policy a couple of years ago, there's now massive tax advantages to investing in those zones, most of which exist in the inner cities of the other states. Detroit, for example, has many of those, and that is attracting capital. I know that Sean Parker, who was one of the early investors in Facebook, has spent a lot of time pursuing some of those opportunities.
Has there been much of a conversation amongst VCs about Elon Musk's confrontation with local government in the Bay Area about reopening, or perhaps more broadly, where are VCs on this right to work or right to back to work movement?
I don't think there's a trend there yet. I've seen quotes, mainly in Twitter, that describe Elon as drunk or on drugs. And I've seen others.
True. Do you share that?
No, I think he's, remember, he's South African. He was raised in apartheid. He hates the state, probably more than anyone, because he grew up in a state that was oppressive. And he's an entrepreneur, an independent-minded entrepreneur, and just wants to get stuff done. So it's completely rational. Whether it's right is another question. I think there's a wonderful debate going on about Sweden versus other places. Is lockdown or is herd immunity the right way to deal with the virus? And the truth is that science is telling us right now that either one of those could work. You just have to be prepared to pay the price. In the case of lockdown, the price is slow death rates. In the case of Sweden, it's faster death rates that come to an end sooner. And most likely, unless there's a vaccine or therapeutics, the death rates will be roughly similar. So I don't think there's a right or a wrong, but there is a fierce debate, and it's highly subjective.
Perhaps a data-driven debate. Perhaps VCs can help us quantify how much a life is worth. How much a life is worth. Has there been a lot of conversation amongst VCs this week about virtual work? The two of the largest tech companies in Silicon Valley, Google and Facebook, this week announced that I think they're not opening the office, perhaps their offices, their local offices, till 2021. Are VCs, when they think about the future, imagining all work going virtual? And is that forcing them to rethink the value of companies and work?
I think that the answer is yes, but it isn't only triggered by coronavirus. I think the rise of Slack and Zoom and similar distributed workforce technology significantly predates the virus and the crisis. One of my personal portfolio companies is Around. It's called Around.co. Is a kind of a next generation Zoom, and is seeing significant traction because human race needs to be able to get stuff done when it isn't face to face. I'm seeing lots of people saying they won't travel in airplanes again for a long time because they now realize there's no need. Martin Varsavsky, who's a well-known Argentinian entrepreneur that started a major Wi-Fi network called FON, lives in Menorca and is therefore resident in Spain, said this week, I don't know when I'll next fly again. So I do think you're going to see lots of investment in technology that can enable productivity along this new model.
I know that Paul Graham put out a provocative tweet. He tends to be pretty provocative. Not everyone agrees with him, but he's a very prescient venture capitalist, early investor. He talked about perhaps a boom in surveillance technology, because now as everybody works from home, we're going to need to measure their productivity.
I'm not sure if he called for surveillance, but he did say that productivity would be an interesting thing to look at in this remote distributed workforce. Interestingly enough, I probably can't talk about it, but my wife's work...
You can. You're on camera, Keith. You have to talk about it now you mention that.
My wife's workplace, Crunchbase, have been remote for quite a while now, and
yeah,
I'll just say I've never seen her get so much done. It is actually amazing when you have the freedom to just focus and there's less interruptions, how much you get done. And I think Paul's implication, and Paul Graham, by the way, is one of the best tweeters. If you don't follow him, you should, because he's always got interesting things to say every day. Usually he talks about his 8-year-old and 11-year-old children and says, something I said to my 8-year-old. And what he's really saying is, I'm talking to you like you're an 8-year-old. but it's great stuff, and he has good insights.
I'm curious, not that you need to talk so publicly about your wife, Shanae, but you said that she does a lot more at home than she would in the office. You have 3 sons all living at home during the pandemic. They're not all teenagers, but they're all close to being teenagers. How is she getting everything done? Are you doing all the cooking and the cleaning and the housework?
You know, I made pizza for lunch, homemade pizza for lunch. I made butter chicken, Indian butter chicken for dinner 2 nights ago. And between the two of us, not that I'm an astrology believer, but I'm a Virgo, and Virgos are incredibly tidy people, and it turns out I am one. So I do a lot of domestic work, but I don't do any washing or ironing, and she's been picking that up. We share the homeschooling. Our youngest is 13 actually, so they are all teenagers now. So we're sharing the homeschooling, every evening around 7 we stop after dinner, and we binge watch Bosch. So there's worse lifestyles.
Keith, back to that tweet from Graham. Are there a lot of startups now which are attempting to quantify productivity? I know Jeff Bezos championed one of these. I think it was a company from within Amazon. Do you see this as a hot area in the startup world?
I don't see it as a hot investable area. And where I see it, it often concerns me. One of the areas that it happens quite a bit is in coding, where the number of lines of code somebody writes and how often they submit are very measurable, and have been measured in some organizations for quite a long time. And I'm personally not convinced that you can quantify how good a job somebody is doing through stats. I am probably the laziest person in the world. I will do anything to avoid work that I don't consider useful. And on the other hand, when I'm really focused on something that I believe in, I'll never stop working. And I would hate to be measured. If you measured me, you'd see this stop, go pattern.
Yeah. Maybe you're the Lionel Messi of the venture capital world. You stroll around the field for 88 minutes, and then in those other 2 minutes, you score 4 goals.
You're a very kind man, Andrew Keane.
Back to the venture capital industry, Keith. What else are you seeing this week beyond the pandemic? Fintech remains incredibly hot, isn't it?
Fintech is going to be hot for a long time, mainly because if you look at the world's money supply, hard cash is about $5 trillion, and the rest is made up of fake cash, debt, and derivatives, and it amounts to about $300 trillion. So the proportion of the world, which is what you could call financial, fake finance is a way to think about it. It's just huge. And if you can topple that mountain, there's a lot of money to be made by shrinking that pile. So I don't see fintech going away anytime soon.
This may be a subject for another show because it's a big subject, but on my daily podcast, Keen On, I interviewed Don Tapscott this week, who of course is the world's leading authority now on blockchain. And we talked about how the need for reliable data was going to perhaps make the pandemic the moment when blockchain becomes real, not just in terms of currency, but in terms of the essential validity and reliability of data. Do you share that? I don't want to get into too much detail, but is there any evidence that blockchain is getting beyond the hype during the pandemic?
I think it's been getting beyond the hype for a while. This week, Andreessen Horowitz released the first 2 videos from a 7-week workshop on crypto and blockchain, run by Chris Dixon, who leads their new, they have a blockchain fund, which they just raised the 2nd fund for. You know, those are great videos to watch. TechCrunch is streaming them. I really recommend going to watch them. But blockchain is really just turning the internet into a massive computer. The blockchain bit,
or the world, not just the internet, but the whole world, right?
The whole world becomes a giant computer, and you can calculate and compute and authenticate and track pretty much anything you want in ways that would have been just not possible before. And when you add tokens and cryptocurrency on top of that, it just gets more and more interesting. You know, Bitcoin this week did what's known as its halvening. That is to say, everyone knows there's only going to ever be 21 million Bitcoin. Well, every so often, roughly every 3 years, the rate at which miners can produce Bitcoin halves. So whereas they could produce 12 Bitcoin every block earlier this week, now they can only produce just over 6. And as a result of that, Bitcoin's price is looking right now, it's at $9,800. It's doubled against gold during the pandemic. Why? Because as a store of value, it represents a fixed supply. The supply is slowing down compared to normal currency, which has got a variable supply, which is growing. So as a store of value, which one would you choose?
Finally, Keith, we began with location, talking about Silicon Valley and New York versus the rest of the world, and indeed the virtual world. Are there any really brave venture capitalists out there who are betting on the physical, betting on analog, getting back into real estate? Anyone investing in restaurants or stores? Or is that sector, the analog sector, do you think in the long term essentially dead now?
You know, if you'd have asked me before the pandemic, I probably would have pointed you to lots of evidence that real estate is a hot area. I personally think liquidity in real estate is going to get really interesting, and blockchain will be part of that. For example, I could use you as an example, but I don't know the numbers. In my case, I've got this house in Palo Alto. It's worth quite a bit. I have a mortgage, like anybody should, because you get tax breaks from having a mortgage. My mortgage is just over $1 million. I own, I don't know.
Mine too, yeah.
So I own about 70 or 80% of my house I actually own. I pay $6,500 a month for the mortgage. It seems crazy to me that I have to use debt when I could use shared equity. Residential real estate is one of the best asset classes over the long run that there is. Anyone who's owned a house over and over again will tell you they've mostly done well by owning over longer periods of time, 10 years and more. Certainly over 30 years, it's fantastic. Now, institutional capital currently can't own residential real estate, so you have the mortgage industry. But what if somebody would give me, the 1.4 million for my mortgage and own 15 or 20% of my house? I didn't pay a mortgage anymore, so now I'd be spending $6,500 a month on other stuff. So that would be great for the economy, and debt would go away. So and I'm seeing lots of companies, Point, Patch, Homebrick, and others. In England, we invested in one called Unmortgage some time ago that buys houses for millennials and then rents them back to them, but allows the millennials to own the house over time through paying rent. There's lots of plays in this area that get rid of debt and replace it with equity sharing. So I think real estate can be interesting, but only if you see the twist. It's a fintech play, not a property play.